Hello everyone, welcome to our discussion of chapter 12. We're talking about management control systems here. Basically our whole next section is going to be about how managers put in place the kind of ability to evaluate and reward their employees and the folks that work with them, and how we use accounting to do that. So we're going to talk a little bit about what makes these systems work, how they should be follow along, what the challenges are. Then we'll get into, in chapter 13, some of the ways that we will utilize the tools in accounting to make them better and actually measure performance. So, and that really is the whole rest of our textbook is really about controlling, rewarding performance, how to measure that, how to know who we're going to reward and who we're going to needs work on certain things. So we have decisions to make. We need some information to do that. And the idea is we want our employees to have the same goals as the organization. So that means that we have to align our control systems to help them understand what the process is and reward the types of behaviors that will actually generate organizational success, or at least reach the goals that have been set by the top management and so forth. So, which they believed that are going to bring about organizational success. Now, what we run into is we need to delegate. There's no way that any one manager as a certain, can make all the decisions and be everywhere and handle all of the problems. So when we do that, when we delegate, then there's that possibility that that individual will make things that are outside of the organizational goals. Okay? So this principal agent, so as the owner of the company or the head honcho of the company, we delegate decision making to agents who make decisions on our behalf because we can't get there, we can't deal with all the customers. Okay, and the extent to which we delegate that out is how decentralized. Okay, so the extreme on centralization is one person makes all the decisions. Okay, decentralized, anything that where that is case is to some extent or another decentralized. Now, almost every organization is at least somewhat decentralized, but to the extent to which decisions can be made at different levels of the organization is the situation that is the level to which an organization is decentralized. So if you're highly centralized, they make a lot of corporate decisions, and that's kind of the thing you hear people talk about. That needs to be done or handled or decided at corporate. This centralized organization, a lot of that happens at corporate. And then you'll hear things like advertisements, okay, where it says, you might hear a bank say, our local people can make loan decisions. They actually see that as an advantage over a big bank where everything's centralized because someone clear off in some office in some corporate headquarters somewhere is going to make the decision. And we're saying, hey, it'll be somebody that you actually could talk to, someone who actually is a person that is decentralized and is looked at as an advantage for the customer, because they are going to have what it says here, local knowledge. All right. So those decentralized decisions can use more local, more specified, specific knowledge than can possibly be brought in and centralized in one location. Okay? So there's definitely some advantages and disadvantages of decentralization. Okay? And remember, it's not an either or. It's not a we're decentralized or not. There's varying levels, right? So companies and organizations are all trying to balance these advantages and disadvantages. The advantages, of course, is the local knowledge. Somebody close to the customer, close to the product, whatever, are making decisions that can manage it. So if you have a problem, that person you're talking to at the local branch, the local location, can actually do something to make it right or to fix it. Or they don't have to call in a manager. They don't have to call headquarters. Okay, so they seem more customer responsive. Okay, they can respond more quickly. They don't have to submit a request. All right, and get multiple days of approval, things like that. Okay, that leaves managers to make the big decisions that are going to guide the organization rather than having them constantly being putting out fires. So they get to focus on big picture items. All right, you break your situations down into smaller pieces because you've broken your company into sections or pieces where each manager has control over that. So you're, as an upper level manager, you're trying to coordinate multiple rather than interfering or getting in the weeds on individual smaller group decisions. And that manager has a manageable situation, a number of people to supervise, all of those things. It's a smaller piece. And they have motivation because decentralized, they actually see what they're contributing to the organization in their little world. It may be just a part of the company, but in that part of the company, they have a lot of autonomy, a lot of ability to make decisions. Okay, and so they have a lot of incentive to learn and watch and move up to other bigger and broader responsibilities. Now, big disadvantage, of course, is as soon as you let other people make the decisions, they may make decisions that don't fit with the overall organizational goals, at least as you as an upper level manager see them. Okay? So that's one of the things we're trying to overcome with our management control systems, is such that we try to align the local managers' incentives with the organizational incentives. There could be things that are done duplicated, meaning, let's say, for instance, ordering certain things. Every department doing their own ordering, okay, they may order the same thing. Not that you don't need it in both places, but you may not be able to generate, okay, economies of scale. Maybe you get a lower price if you ordered in larger quantities, but because everybody's ordering their own, we never reach that, okay, because it's decentralized. Everybody makes their own hiring decisions, okay. It may be that we're keeping files in multiple places for various things. Vendors are being paid out of multiple offices, all that kind of thing. That's the duplication that sometimes we try to avoid by centralizing things like payroll, where there's a lot of administrative paperwork that needs to be filed and stuff like that. Okay. There also is a possibility that because you just live in your little part of the business or your part of the organization, that you make decisions that, while beneficial to your part, don't do well for other parts because you don't see the whole big picture. All right. Maybe because it's not shared, maybe just because you're focused on what you need to accomplish. All right. So those are the drawbacks. Okay. Are we more responsive? Do we have things that can be streamlined because we handle all the payroll in one place for all of different offices? Do we really need a payroll individual person or processing software, all that kind of thing in every place? Or can that be centralized? Do we pay the bills all in one central location? Do we do our hiring through one central location? Or is that something that does better with local knowledge and responsive to the individual needs of each individual business unit? Okay, so it's not a clear-cut decision, and these businesses move back and forth over time depending on the challenges they face in the environment, and sometimes but from their competition. So if we're going to decentralize, and we're going to at least some extent delegate out decisions, okay, then how do we make sure that those that we've delegated to understand and make decisions that are going to be good for the organization as a whole, not just for themselves, or even for their business unit. So to make this work, you kind of have to have three pieces. Okay, we have to give them the authority. Okay, and you can't just hold people accountable for stuff that you haven't actually given them the authority to do something about. It's very frustrating to not have the authority you need to actually make things work. Okay, so you got to be real about delegating that, and then set up a way to measure that they're meeting the goals that will help the organization. So you need to take the big picture goals of the organization and break them into pieces that make sense for that particular business unit. All right, so that you can evaluate them against that goal. So obviously accounting becomes a big part of that, right? We measure in accounting profits or what costs or whatever element it is against our standard that we've set and goal that we've set for that particular action or activity. And then reward or compensate the people for reaching those goals in an appropriate way, so that now their incentive, meaning getting more money, is aligned with things that will allow the organization to prosper. Okay, so that's the idea. So even though they may selfishly have alternative motivations, because we've aligned their compensation with the goals of the organization, they are motivated to go ahead and do the things that will make the organization work well. And that is not an easy thing. It's not a simple thing. It constantly requires updating and changing to make it work better. So, example, that you want all three of those pieces to be working together, all right, in balance. So the goal of the organization to make money, sell newspapers. Newspaper stand manager, though, can make good decisions about the number of papers to order. Okay, so to balance that with how much they think they're going to sell. Okay, we want a system in place that measures your performance against what we would expect, right? So that would make the whole organization prosper. But if that measure, for instance, I can't do anything about as a newspaper stand manager, if nothing I do can make that any better, okay, then I lose motivation, okay, to make better decisions. If I see it out of reach, meaning either the goal is just too far out of reach, or it's too easy to reach, or it is something that it doesn't seem to matter what I do, it doesn't change, okay, then after a while that management, that control doesn't have any influence on my decisions. I make my own decisions based on my own perspective, and those other goals just don't work because they're either unreachable, they're too easily attainable, or I just feel like I'm out of control of the situation. Okay, things aren't in balance. So to do this, we use the term responsibility accounting. So I get accounting or get information about my area of responsibility. So the group vice president has a large umbrella looking over multiple investment centers. Okay, an individual manager may only have a discretionary cost center or profit center, and we break it down into smaller and smaller pieces with just revenues and costs. So we need to define these centers, how we've divided up our responsibilities in the organization. So a cost center, if we're a manager of a cost center, we can control the cost. So we're looking for efficiency. All right. What we have inputs, if we want to achieve things like 90% on time types of production, that sort of thing. That's going to divide our costs. Can we get 4 products per hour? All right, because we don't have responsibility for sales. We're not worried about selling more. We're not interfacing directly with customers. So we are supervising our costs to try to find the most efficient way to get the input that's expected. Now we may hopefully have some input about how many items we can actually produce, but ultimately we're really talking about what does it cost to produce a single item. What's our hour, our direct labor, our direct materials, our overhead, how efficient are we at using those to produce our product based on this is what we have available in our resources. Okay, now outside of production, okay, more of a, we call this a discretionary cost center. These are legal, okay, accounting, that sort of thing, research and development. These pieces, which is not a production output. We don't measure the output of accounting or how much input that comes into it. I mean, pieces of paper flow through the office, or how many data bytes of information. That would be very difficult. But we do, okay, want them to be able to, accomplish certain things at a reasonable budget cost, right? So there's usually referred to it as discretionary because they're not driven by production. Now, some pieces for like accounting, for instance, I have seen measures where they will measure, okay, the accounting needs to process so many purchase orders or so many invoices, so many other things like that. How many paychecks for payroll? Those might be some of that input thing similar to production, okay? But most of the time it's usually looked at as a discretionary kind of a overall goal and budget that we want to reach, be able to operate and accomplish all that we need to within that budget, within that set amount of resources. Now, revenue centers are only concerned about bringing in revenue. They're not worried about costs, okay? So they may have some ability to negotiate price with customers. If you're in charge of a revenue center, you may be able to give discounts in order to drive up volume, okay? So typically at a retail level, as a manager of a particular section of a big box store, for instance, you want to push sales. Okay, you may even have some discretion about what goes on sale, what specials are offered, but you have little to do with the cost. Meaning everything's ordered and it comes into your thing. You may get feedback on certain trends or things like that you notice, but you are really just managing the customer experience. You want to make sure that everything is well lit, everything is out and looks good and is presented well so that people buy it and people want to buy it. But you don't have anything to do really with the cost of the items that go up on the rack. That, for instance, you didn't buy them. That you just have a revenue responsibility. Your sole vision is on bringing in traffic and selling product. Okay, you may not even know what profit margin is or contribution margin is on individual products to know which ones are even better to sell than others. Now you might, but many wouldn't even have that. Now, expanding the realm of, so you could have just revenue, you could have just cost. What about if you have revenue and cost? Now we're called a profit center, okay? So when you operate an individual store where you've got some responsibility for customers, you can set prices, but you also have the ability to set how much is paid to your employees, how much you buy the products for, things like that. All right, then you've got a cost and revenue. So really the best way to look at how successful you are is profit, because you could have trade-offs. So maybe you give a discount so that you can increase profitability because it's a situation where the extra volume will bring in other folks, and that will offset your costs because you have some say over both of those. Now, the next bigger picture is investment center. This is where not only do you have revenues and costs that you can control, you also have the ability to have a say in how much is invested in terms of assets. Do we expand to have greater machinery or space or any of those things? Do we have the decision-making power to decide about capital assets, capital budgeting, that sort of thing? And therefore, now you want to compare not just what they can make, their profit, revenues and expenses, but compare that to what they have available in terms of resources like assets. Because obviously a segment that has a large amount of assets should have greater amount of profit. I mean, that's what you would expect, okay, in that situation. So that's an investment center. And that can be, again, none of these are absolute, cutoffs, because you may have investment centers where they have partial control. They can make suggestions, but they don't make the ultimate decision about buying an asset. Okay, so does that make them investment center or not? Just we're not going to split hairs about that, but you want to understand that if someone is going to be evaluated using investment center measures like comparing profit to assets, then they need to have some control, even if it's partial control, over the amount of assets. If they have no control over the amount of assets, then it's very frustrating to be evaluated using a measure of those return on those assets, okay? Because they can't make that final determination. So again, you've got the basic. Further down the chain, you might say in a hierarchical way, is usually the delegated authority is just the cost or revenues, that sort of thing, okay? So when we want to measure performance, we want to achieve this situation where everybody knows what their purpose is, how they fit, what they're evaluated using, okay? And that how that evaluation or how their goals fit in with the organizational goals. Okay? So and then we create a reward system that rewards them for reaching the goals that will further the organization. And so regardless of what my personal goals are, I'm at least have the goal of being rewarded and evaluated positively given the organizational goals. Now, we may decide to compare, and this has its upside and downside. I mean, obviously, there's some level at which you need to say, okay, we've reached a certain goal. You've done as well as other folks, or you're doing better, and especially if we're trying to decide who to promote or who not, who to give more responsibility to, who to give more delegated decision making to, because they've done well and they've done better than others, okay? But we have to be very careful, because individual sections of the business have different risks, have different challenges. Obviously, if you have lots of resources, or in a particular area of the country or something like that where things are going well, you may look better even though you aren't making any particularly better decisions. Okay, so we have to take into consideration a large number of factors when we make comparisons, and not just one measure across the board. Either you reach this goal or this measure, or you're a failure, or you didn't do well. So ideally, then we line up our compensation. Now, everybody should be paid something as kind of a flat, or for doing their work. But what contingent compensation? What should we reward? And how should we measure whether or not someone gets a bonus? Okay, that's a term that's usually used. Do they get extra on top of their regular pay because they excel, because they reach certain goals, because they align their decisions with the organizational decisions, that sort of thing? Okay, and therefore make the organization more successful. So in doing this, we have to be a little careful, okay, with the corporate cost allocations. Now, I'm not going to we're going to go through this very quickly, because generally allocating corporate costs are not a helpful thing in evaluating performance by your individual pieces of the organization, okay? Unless it really reflects the organizational resources that are used by that particular cost center, profit center, whatever center we're looking at. So, for instance, in this example, okay, our European division has sales revenue. They hit exactly their target sales revenue. Their direct division costs were exactly what they targeted. The only thing that was different, okay, was the amount of corporate overhead. So our operating profit was below, you might say, our target. All right, that's very frustrating, okay, if you are the manager of the European division and you have no control over the allocated corporate overhead. You don't have any control of the whole company's overhead and how it was allocated. And just because other parts of the organization use different levels of resources, or the whole corporate was a different level of resources, you have 4,800 instead of 3,500. Okay, allocated. And that can feel very discouraging if that means that your evaluation doesn't reflect how well you did. All right, so most of the time I would argue that shouldn't be included at all in your evaluation, unless there is something measured there that says, okay, European division, yes, this was allocated, but it was allocated because you require more resources than the Asian division. And therefore, it's appropriate. You require more resources than the 16% of corporate revenue that you, because you have these needs, or you have this extra cost for hiring people, or some other thing about your turnover. Maybe you have too much turnover and therefore we have to always be hiring new people. Then maybe it makes more sense to allocate some more resources there. And maybe that manager wouldn't feel so badly about being evaluated if that was the allocation. And you said, okay, well, if you can find a way to reduce your turnover, then that would mean less corporate overhead allocated, because our overall corporate overhead would be lower because we don't have to spend so much time hiring to replace the people that work in your department. Okay, something like that might make sense. Otherwise, it seems very arbitrary and not very helpful in evaluating the European division. Okay, so you might say, I would, look at just this piece. Okay. So you can see that part of the reason why this allocation was different is not because of our revenue, but because of overall corporate revenue was down. We didn't have anything to do with that. Okay? So we look, even though it was a percentage of corporate revenue, our percentage of corporate revenue went up because we maintained our percentage, our sales, when other folks didn't do as well. That's really disheartening, because now we're being penalized, if you will, for others who didn't do as well. That's the epitome of a bad evaluation system that is now going to, if it follows up with reward or compensation, is going to be very discouraging. So, see, we have higher costs allocated to us just because our sales stayed the same. Okay? There's also the problem, okay, with unethical behavior. Okay, if we put too much pressure on our managers to reach certain goals, they will reach those goals. They may even be tempted to do things that are not right, or even to the point of illegality, to make their performance look better if we have too much emphasis on. So, for instance, if my regular pay is half and there's a bonus that's half of my compensation, I am really anxious to reach the goals that will allow me to get that bonus. That's a large percentage of my ability to live that is dependent on reaching those goals. I would have to be very honest and very forthright to not be tempted to do anything from change the numbers to forego something that you should have purchased. The common thing that comes up is, if we're basing it just on profit, and certain things like repairs and maintenance are going to come out of that profit and therefore make the profit lower, we may ignore needed maintenance on machinery in order to look more profitable, and that may get us to that level that we get our bonus currently, but at the detriment of our long-term success, because that machine is going to break down faster and then we'll have to replace it. Okay? And that could be very problematic. It could be lower quality that's going to make our customers mad. Okay? That may take a couple of years to figure out that that's what's happening. But that's the kind of incentive we don't want to push too hard on. Okay? And towards the end of the book, we'll talk about a variety of performance measures. We'll stay with accounting, quantitative ones here for a little bit in the next couple of chapters, and then we'll move into things that are not dollars and cents, partially to avoid this emphasis that may lead to unethical behavior. So what can lead that? Unrealistic budget pressures, especially in the short term. Okay. Bonus plans are very short term, but are a big part of your compensation. All right. And then, of course, there's the lack of internal controls. If there is not kind of a balance between reaching goals and having the right internal controls, which means you have to have various approvals. There can be segregation of duties, meaning if you have custody of certain assets, you cannot keep the record keeping. Okay, internal controls are trying to make sure we're effective and efficient, that the dollar amounts and financial reporting that we're looking at is reliable, and that we aren't breaking any rules that are going to cause us to be sued or something like that and really lose lots of money. And of course, the problems with this is what led to the Sarbanes-Oxley Act of 2002. Okay, lack of internal controls. There was no oversight, no segregation of duties. Okay, but don't forget that even good internal controls have a cost. There is a cost to everything. So if you want a second approval of a certain, say, a purchase of an asset over $5,000 requires a second approval or something like that, there's a cost to that. That means there's additional time on that manager's part, things to make that approval. You may miss out on opportunities that you need to act quickly, things like that. Okay, it may be worth that cost because then someone can't buy it without authorization, and that may be a good thing. But we should never think that internal controls are zero costs. They do have costs, and many times the benefit is greater than the cost, but we want to design them to be as low cost as possible and still achieve our goals of trying to make sure that we're efficient and effective. Some other examples: reconciling, limits, authorization, okay, keeping out particular activities. Many of these can be accomplished with technology today. Passwords to protect various access to various things that are only shared with certain folks, and therefore they can't actually get into it, rather than paper and extra signatures and all that stuff like in the old days. Now it's much more electronic based, which means we have a whole new set of challenges, and that is, what does the technology allow us to do, and how do we make sure those controls are working? It was one thing to look at pieces of paper and say, oh, there's a signature. Now the computer is doing those things, but how do we make sure that it can't be hacked or it can't be compromised in some way, that we're not sharing passwords, we're not sharing access, that sort of thing. How about your computer IT people, that they are keeping it up to date and working so that it doesn't lock people out that it shouldn't lock out, and that's a cost, right, of that control. So that's the newest, you might say, up-to-date way of dealing with all of this. Is now it's all computer-based. This delegation of responsibility, this performance measurement. On one hand, it gives us a lot more flexibility in measuring performance, because we have a whole host of ways to do it electronically, and compensation even for that matter, to make it more complex, but yet also more vulnerabilities, in that if you have certain passwords, you can get to anything, that sort of thing, and that type of access.